This is Shun, master of the white crane system. From the crane, we learn grace and self-control. The snake teaches us suppleness and rhythmic endurance. The praying mantis teaches us speed and patience. And from the tiger, we learn tenacity and power. And from the dragon, we learn to ride the wind. All creatures, the low and the high, are one with nature.
Hi, welcome to this video today, which is all about a flexible, simple strategy that trade all different market conditions. And I think that when traders come into Forex, they want to be too rigid. They just want to have one set of rules, and they want to follow them religiously. And you're never going to make a lot of money doing that. It's one of those things where Forex trading is about being flexible and reacting to different market conditions. You need different tactics and different skills to win, as the market conditions change. On the intro to the video, I've just done a quick clip from the series Kung Fu, which stresses this point. And I think it's something that traders really should take into account, that you need to go with the flow and respond to different market conditions. Most traders won't do this. They're simply not confident about thinking for themselves, and also they do believe in the scientific theory of market movement, which is complete nonsense. You really do have to think to win at Forex trading, in my view. And it's not as intimidating as it sounds. Forex trading is very simple. If you can spot the different market conditions, which is easy, you can then vary your tactics to win. Three different market conditions are, prices been moving sideways in a range, then they'll move to trend following phases, so trends move up strongly or down strongly. Then you'll have what I call the blow off move, which is basically where prices really accelerate strongly to the upside or downside, which is normally the end of a trend. Prices come back to more realistic levels. Now, if you're trading these three different market conditions, you can do so with the same strategy. And my own view is to put inputs into the strategy which can be adapted to all those three market conditions. Now, the first thing you need to put in is a volatility indicator. Okay. Secondly, I think you need momentum indicators. And thirdly is obviously trend lines of support and resistance. Now, if you have volatility indicator, a momentum indicator or two, and you've got your trend lines, I think you've just got a simple mix there that can basically trade all the market conditions that I've said. And a lot of traders will be using candles. You can use them as well. I tend to favour a simple bar chart, and I just really like to look at the range and where the close is. They're the most important things for me, but by all means use candlestick charts. But I think you need to know about volatility to trade all those market conditions, and you also need to basically have momentum indicators to judge overbought and oversold. If markets are trading in ranges, volatility will be low. Okay, you can see that easily on a chart. And basically, you can see the support and resistance. All you're going to do is use momentum. And momentum is going to be the most important criteria in taking a trading signal. If you're trading into the top of the range, you want momentum to be overbought and go for divergence and look for a turn down. And at the bottom of the channel, you're looking for basic momentum to be oversold, and it's turn up with divergence to take a trading signal. It's quite simple trading within ranges, in my view. When trend following comes into play, you need to basically, obviously keep momentum in mind. If a breakout occurs to the upside, it should be done on momentum that is not overbought. Okay, to the downside, not oversold. Once the trend is in motion, okay, there's a key element that comes into play. I'm going to use it, I call it the mid-Bollinger Band, which is a 20-day simple moving average. That is the value area. That then becomes very important when you're going to be putting in trading signals. within an existing trend. If you look at any trend, when prices dip back to that 20-day moving average, they will normally find support around that level or a nearby support level in an uptrend. And that is, one of the inputs of the strategy that you need to pay careful attention to in a trend, because it allows you to buy back to that level, okay? Then you use momentum to confirm the signal. So what you've done there is you bought in the middle Bollinger Band, the 20-day moving average, to be very important when the trend is underway. It's not so important when prices are trading in a range, in my view. When you get to a blow-off phase, what you're looking at then is the outer bands of the Bollinger Band, and you want prices to get outside them, or be really hugging those bands, get outside them, and then look to basically take, let's say it's an uptrend, take a downturn. So basically that input has become very strong when you're in a blow-off phase. So you're really looking at that outer band. Then you're looking at momentum, okay? So momentum then is basically going to help you get in the market. If it's very overbought, you can do divergence. But the mid-band is still important, because in a blow-off phase, prices will come back to that mid-band. Okay, that's a simple illustration of adapting a strategy to different market conditions, where you bring different things into play. For example, I'll give you just another indicator that I use. I only use it in one way. It's the ADX, and everyone uses that as a trend following indicator. I'll very often have that and look at it, but I will do nothing. I'm only looking for one thing to happen on that indicator, and it's a move above 40 and turn down. And that will normally happen when you're getting close to a blow-off move. So that indicator is important there for me, and I only use it in that way, just to signal that a trend change might be coming. Don't use it in the trend following phase. Okay, so what you can do is you can get indicators, okay, and obviously your trend lines, and you can place different emphasis on different inputs at different times. And okay, you have to think a bit about it and use your judgment. But if you devise a simple strategy that is flexible, you can trade all different types of market conditions. You just simply react to what you see. And it's very simple, but it can be very, very effective. And I've seen traders produce far more complex systems than I've just done, with very complicated algorithms, but they have too many inputs. And not only do they have too many inputs, the input rules are too rigid. They break down in the changing market conditions. So never believe anyone who tells you complex systems will beat simple ones. They won't. Also, rigid systems will tend not to beat a flexible system. Flexible system does rely on you thinking, but it's really, in my view, common sense after you've learned the basics, and you'll instantly know what to do when you look at different market setups. You'll just put different emphasis on the rules or inputs of your system, and then you'll be able to trade those trading signals for profit. So thank you very much for watching this video today. Forex markets are simple in many respects, but they are ever changing. You just need to react to that change with a simple strategy, and you'll win at Forex trading. Thank you very much for watching me. Take care. Have a good day.
As no two elements of nature are in conflict, so when we perceive the ways of nature, we remove conflict within ourselves and discover a harmony of body and mind in accord with the flow of the universe.